showed in the balance sheet. It is showed in the balance sheet as here. Common stock, the paid in capital will be here, and the common stock is 500,000, so total is 100,000. And then we write it down the retained earnings, so that's going to be our total equity. Okay, so no par common stock, which means the share is issued with no par value. The one share is how much we don't know, we call this no par value. So Apple Corporation issues 939 million shares of no par common stock for 16422 million, right? Entry would be cash to common stock, simple, because there is one share is worth of how much you don't know, right? So just receive cash to common stock, total amount this much. And how we gonna write it down here? Because we issued, how we can find out the shares? So no par value, number of shares, the amount they received divided by number of shares they issued with no par. So we write it down. This is going to be retained earnings. So that is also, if we have other comprehensive income, we write it down in our equity as well. This is how we show no par common stock value for balance sheet in the balance sheet. Let's talk about the preferred stock. Preferred stock. So it's follow the same pattern as accounting for common stock. Just the nature of the preferred stock is a little bit different because they are given preference when dividend is declared, when company is liquidated, but they are given fixed dividend. So they may have separate account for paid in capital in excess of par for preferred stock and common stock. So it can be issued with conversion feature, like I told you. After some time they will be converted into common stock. So what if they are issued with the feature of convertible preferred stock, right? So company issued preferred stock of $1, 50,000 shares. Convertible feature, which means you receive cash and then you call in convertible preferred stock, right? Cash to preferred stock convertible, right? So convertible preferred stock to common stock at a rate of 6.25 to 1. What does it mean? It means for every 6.21 preferred stock you will be given one common stock, right? So it means you are given 8,000 new shares, common stock shares, in exchange for 50,000 shares, right? So you divide where this 8,000 came from. You can also find out that answer would be 8,000, right? So entry would be reversed. So because this is convertible, after some time it is converted, then we reverse the entry for convertible preferred stock, because preferred stock decrease mean equity, increase mean credit, equity decrease mean debit. So we convert or we delete this account preferred stock. So preferred stock 50,000 debit. So we issued common stock, which is par 1. So it means common stock 8,000 multiplied by 1 par value 8,000, and the rest is the premium or paid in excess of par 4,200. So did you notice here we don't use the word discount and premium, right? So we use the word paid in excess and paid in capital, right? So you can just understand that if we talk about paid in capital, paid in excess, we are talking about premium, right? So the categories of shares, if you notice that in our previous slides when we talk about how we're going to show equity or shares in balance sheet, over there is written authorized, issued, and outstanding capital. I didn't explain over there because I know that in this slide we're going to explain it. Authorized mean it is the maximum number of shares the company can issue under its charter, right? Issued mean what the number of shares already issued to its customers, right? Outstanding mean number of shares that stockholders own. It means number of shares in the hands of stockholders, right? So it looks same, right? But these are not, because sometimes company buy back its shares as well. When company buy back its shares, so it is included in issued, but it is not included in outstanding. Okay, when company buy back its share, we call that treasury stock. Discuss that. So issued shares are reacquired by the company. What are the reason? Reason are that make shares available for employee stock purchases. When company, when the employees about to retire, rather giving them handsome amount, the company declare that okay, we are giving you ownership in our company because you served our company very well. So you have to be given shares. Either you issue new share or either you purchase back or you repurchase the stocks existing in the market and you give to your employees. And the other reason is to earn profit, buy low, sell high. If you know that right now your share in the market is trading at low price, you buy back and at the end you issued into the market again. Plus, the reason to buy back is to avoid takeover. Whoever controls 51% of the shares controls the company, or yes. So whoever controls 51%, they can change the management as well. They can say, look, I don't want this company. I want this company to sell to that company, or I want this company to remove the CEOs or don't declare the dividend. It's like that. So whoever controls the 51% shares, that becomes the owner of the company, and by purchasing the shares through open stock exchange, you can become the owner of the company. So in order, if the company knows this kind of strategies, so how the company can save itself from this takeover, company buy back its shares. And when the company buy back its share, the earning per share is also increased. We are not discussing right now here because this is the concept of finance, and also used in share repurchase program, that is also part of finance. But just think about that, if you are making heavy profits, the question is, would you like to share your profit to others? The answer is no, right? So why you share, if you know the strength of the company, if you are very confident about the future of the company, if you know that we will be making hefty profits, so why, so question is, why to issue shares, or why to spread the profit amongst a number of owners? It's better to pay back them money and repurchase your shares. So how treasury stock is recorded? So recorded at cost, not at par. Classified as a contra account for the equity. It means increase in treasury stock means debit, but it is the opposite account for equity. When normal account of equity increase, it's credit. When treasury stock increase, it's debit.